OpenText reported earnings yesterday after the close. The stock is slightly down today. Last I looked at, let's have a look right now. After the software firm reported lower revenue and adjusted earnings per share year over year. So the stock is down 1.37, so $1.37 or 3.7%. We have the CEO and CTO of OpenText joining us now. Mark Barrenechea joins us to talk about those earnings results. Mark, thank you very much for your time.
Marella, great to be with you today.
So revenue, as you noted, down 13% year over year. What factors led to that drop?
Yeah, sure thing. And just mind you in those numbers, we had a divestiture during the year. So less that divestiture and some anomalies in our business, we're really down about 1% year over year versus the headline given our acquisition and a couple of one-time items. So the true health of the business was down 1%. What impacted us was tariffs. And in early March, with all the tariff announcements, and we saw the auto tariffs to be a tipping point in the marketplace, which just created so much uncertainty. Many of our customers paused to understand the overall environment before they started to spend again. But even though we may not predict revenue, we came in 50 basis points below our projection. We're going to control what we can control, and we had a stellar earnings quarter. We overperformed on EBITDA. We had record free cash flow, and we also delivered a record buyback within the quarter as well. So where we came in 50 bips below revenue, we're going to control well what we can control, and that's our earnings and profits and free cash flows.
Okay, let's talk about your exposure to the trade war, because as you mentioned, a lot of company leaders are pausing spending because they don't know what's coming ahead with the economy. Are you also exposed in the U.S. to contracts with that government trying to rein in its spending and cutting contracts?
We are a very proud and strong partner to the U.S. government, and remain so. There's no doubt that we are working with our government partners to understand the optimal way to consume, the optimal way to spend. And we had de minimis impact in Q3. But we're here to work with our fantastic partners across defense, intelligence, and civil agencies to make sure we're meeting their expectations and their new budget constraints. But we've only had a minimal impact. And we expect the U.S. public sector to remain a very strong and strategic segment for us. As
a result of the trade war, as a result of that exposure, are you revising revenue outlook for 2025?
Yeah, it's a great question. We have not changed at all for our fiscal year our guidance on margin, earnings, free cash flow, or capital returns. In fact, we're going to work harder to get to the high ends of our free cash flow range here in the remainder of our fiscal year. We're an incredible offensive stock as well as a defensive stock, and we excel operationally through all economies. So we haven't changed any of our earnings, margin, or free cash flow outlook. In fact, we're going to work harder to get to the high end of our range. Revenue is a little harder to predict right now. And some companies are pulling guidance. Some are doing dual guidance like United Airlines. We have adjusted our range slightly. And look, if we really have hit max tariff, or if tariffs start to ease, we'll perform better. But we moved our revenue guidance $70 million on the year on a base of $5.1 billion. But we haven't changed our earnings, free cash flow, or capital return guidance at all.
Okay, let's talk a little bit about your automation plan that is being rolled out.
Sure.
How much will you spend on that this year, and what does that look like for the rest of the year?
Yeah, we've announced a AI-first strategy, and we have stopped hiring, actually, roles that can be done by AI. We've added AI into our hiring, into our talent plans, our performance plans. We are live on our own product and partner products across the company. We announced a business optimization yesterday of taking out up to $400 million of new expense and creating an AI-first operating model of all that operating discipline you expect from Canada's leading software company. So we're leaning in very strongly into AI first. Our new product, which we just brought to market, introduced 100 new digital workers And our release in the summertime is providing a tool, Aviator Studio, so our customers can begin to create their own digital workers and create a limitless workforce through digital workers. So we have an AI-led strategy. We're spending roughly $1 billion a year right now in engineering and AI, and we're leaning all in on AI first.
So I know that as part of your automation, you mentioned you brought on 100 digital workers, but you do expect some job losses as a result of that.
Yep.
So tell me about that.
Yeah, so in our business optimization extension that we announced, we will be taking out $400 million of expense over the next 2 years, and we'll be net reducing our workforce by 2,000 jobs. And those are jobs that can be done mainly by AI. These are roles in customer support. These are junior programming roles. They're documentation, QA, general administration, general knowledge worker. And it's time for companies, and we're going to lead the way, it's time for companies to deploy these tools. Like, I remember when ERP came out in companies, and G&A expense was like 20% of a company's expense, but ERP brought it down to high single digit. AI is going to do the same. We're going to lead the way. We're taking $400 million of expense out, and up to 2,000 roles.
Okay, so you've given me an idea of how much you're going to spend on AI. You are rolling out a product, I guess you said in the summer. What's your expected return on that?
Yeah, so we don't have F26 guidance in the market yet. We're gonna bring that out in August, but the indicators are very positive. Our growth rate will advance. Our free cash flows will grow. Our maintenance business will expand as well. And F26 has a lot of positive indicators for us, but we don't have that guidance in the market yet. We'll have it in the market in August. But we're expecting F26 to be just a very different year from 25, led by AI. And one of the early indicators is our Q4 guidance, where we're expecting very strong bookings growth of near 30%. Bookings growth driven by AI.
Mark Barrenechea, I have to leave it there with you. I'm out of time, sir, but thank you for your time. Thanks very much for joining us on The Close.
Marella, thank you very much.
All right.